Right, good day learners. In question 53, you are actually asked to do a debtors collection, which we have already revised, and then you're asked to complete a table. And the table is actually asking you to determine the difference between a cash budget and an income and expenditure. Now, right at the beginning of this chapter, under the questions, there's a video explaining the difference. Now, it's important that you actually check and go through that before we go further with this exercise. So let's start off by looking at our sales. You are told that your projected sales for next year, and there you're given May and June, and they're also given you the cost of sales. So this time you don't need a markup to calculate it. You are told that the cash sales amount to 70% of the total sales. Right, we know from the past then that if in May the cash sales will be 70% of the 420,000, which will mean 294,000. And you will notice that some figures have been filled in for you, but that 380 was just the 70% for June. Now just look at this table. This is the receipts and payments. This is your budget. This is the actual cash entries. This is your projected income statement, which would be used to work out a profit. So it's only got income and expenses. Now, as this is a cash sale, it's affecting your bank, so it goes into the receipts. The 30% that is on credit will obviously be put into your debtors collection schedule. And we've already revised that, so it's 126,000. Right, then if we look at the instructions, it tells us that 40% of the debtors settle their debts within the month, so that's the same month, in order to take advantage of a discount. 55% in the month thereafter, and then the outstanding balance, because again, if we look at those two, it only comes to 95%. So there's an outstanding of 5%, is to be written off as irrecoverable. It's a bad debt at the end of the month following. So first of all, we've got to work out the cash we're going to get, but then both discount allowed and bad debts are expenses, which means it's going to affect your income and expenditure. So going back over here then, if we've got 126,000, and it says to you that 40% of that will be received in the same month. So just working it out, obviously the 40%, first of all, that are paying 50,400. Now those are the people that are getting the discount. So we work out the discount, which is 5% of that. And that means in cash, I'm only getting 47,880 in the same month. So in the month of May, I'm going to get 47,880. But what's important is that this discount allowed is an expense, and it's been allowed in the month of May. And so under discount allowed here, we are there, they would insert the discount of 2520. So remember, discount won't go into your cash budget because it's not money, but it will go into your expenditure. Now the same thing with June. You go back please and just work out what the discount was when the 165,000 was paid. Alright, so working the 40%, you get 66,000 is going to be paid. 5% of that is going to be a discount, so you're only receiving 62,700, which is a figure they actually gave you, but at this point you can actually check yourself. The 3,300, the 5%, and that is going to be your discount allowed. Right, now remember they actually told us that 5%, well, we worked it out, it was the 5%, the balance is not going to be paid, and it's going to be written off in the month after the sale. Remember, looking back here, it's written off at the end of the month following the sale. So therefore, what we sell in April, some will be received in April, some will be received in May, and then the balance is going to be written off in the month following. So it's going to be in May. So in May, we're going to write off 5% of the 108,000. In May, over here, those are your sales. You get some money in May. You will get some money into June, the other 55%. And then in that same month, you're going to write off the 5%. And so 108,000 was your April figure. 5% of that, 5,400, and that will be your bad debt. The 6,300 that they filled in is the 5% of May's figure. So first of all, you had to watch which month this is taking place, and it tells you in the month following. Secondly, and this is where the confusion comes and what makes it a bit more complicated when you're working both of these together, because you now at one point you're focusing on the cash, but there are expenses being incurred. Right, now just before we go off, remember that that was your total sales, so that is your income earned. That is your cost of sales. That is what those goods cost you, and so therefore those full figures will go into your income and expenditure, and you can see that they've already been filled in. Right, but now let's work with this cost of sales, because if we have sold these goods, we've got to replace them. And this is where they're telling me over here that I'm working at a fixed base level of stock. In other words, whatever stock has gone out of the business has to be replaced, so that you've got the same balance of stock at the beginning of every month. And that is why we are buying back everything that we've actually got rid of. It also says the owner withdraws 8,000 per month. The 4,000 a month is in cash. That's going to affect your bank. The other 4,000 is your trading stock. That is going to mean less trading stock to you, but it's not a business expense. The business entity rule says keep the business and the owner separately. So that drawings over there, you will see, will become payments for the cash that gets taken out. The other 4,000 doesn't affect your bank, and it's not an expense for the business. And then 30,000 rands worth of goods are going to be donated. Now again, there's no change to your bank balance here with this, so it doesn't go into your bank account. But that 30,000 is an expense. So it would be a donation, an expense in your income and expenditure. Now I know you're probably going to say, but it does affect the bank because you're not getting that money in and you had to buy the goods. Yes, but this is where, and this is why it's important, what we've got to remember is that although that's the value of the goods that we actually sold, that's not the only goods that went out. The owner is taking 4,000 rands worth of goods a month, and we have to replace that because it said we had to keep a fixed stock level. So we also got to replace that. There was also a donation of stock. You've got less stock, so you actually have to replace that stock as well. So the goods that we have to buy back is our cost of sales plus this. Very important. Now once you've got those figures, you can then go on and say to you that 80% is paid for in cash, but they get a discount of 10%. Now let's just go over. This is a cash discount, or called a trade discount. This discount is taken off before you even pay for the goods. So no entry's been made before this point. And the historical cost rule says enter at the price you've been charged. So you are only going to show your cost at less than 10%. That is my cost price. That's what I'm paying. So there is no actual entry for the 10%. You are going to just have to work out what you pay. And then the other 20% will be bought on credit, and you'll pay that in 1 month later. So let's just fill those figures in. So let's look at May's figure. Our cost of sales plus the 4,000 that the owner took gave me a figure of 266,000. 80% of that is cash, and then we're getting a discount, so we're only going to pay 90% of that, so we're paying 191,880. And you can just check that is the figure they gave you. The 20% of the original amount is going to be bought on credit, and it's going to be paid 1 month later. So what you buy in May, you'll pay in June. And then you work the same calculation for June, but remember June was the cost of sales plus the 4,000 plus the 30,000. And then you do the same, you work out 80%, and then say, right, I get a discount, and you'll calculate, you get the 271,980. Nothing at this point gets recorded in the income and expenditure, because those we are working with the cash items. Right, let's look at the next point, the rent income. And it says here the rent is 5,000 per month. This will increase to 5,500 per month as from the 1st of June. And the rent for May was received in April. Now rent income is an income figure, so it'll go into income and expenditure. But because you're also receiving it, it's going to affect your bank account. So let's go back here now. Your May's rent, the actual amount that you're earning is 5,000. That's what you're earning. The person was in your premises and you earned 5,000. But that 5,000 was paid in April, so it went into April's bank account. So you actually didn't get any money in May. Whereas they don't give us anything about the June, so therefore it'll be exactly the same. It gets received in June, and it's another income that you've earned. Right, and so the last point, the rates and taxes. Rates and taxes is 3,500 per month. Rates and taxes is an expense to us, and it also is a payment because we do have to pay it. But now read all the details before you rush ahead. The account for April was only received in May and will be paid together with the May's rates and taxes. So although the expense is incurred, every month you get charged 3,500. The payment for April wasn't made in April, so it didn't go out of April's bank account. It will only be paid in May. So while your expense will be 3,500, the payment in May would have been April's, you're paying last month plus this month. And then the last point, First Traders has decided to pay the rates and taxes annually, 12 months from the 1st of June. The annual amount will be paid on the 1st of June. And no new land and buildings are expected to be purchased during the financial year. And the only reason why they're telling you that is because if you did, it would have affected the rates. We are now paying it annually. So 3,500 times 12. Your payment is for the full amount. And thereafter, as you move forward, there will be no more payments till a year later. But the expense is still incurred every month. Every month that you owe that, the expense is being added up. Right, learners, this is a challenging exercise, but it's one that you will often get faced with, because it actually really can determine whether you understand the difference. And so I would suggest that you redo this exercise and then go on and look in your study guides and work with the cash budgets and the income and expenditure, keeping in mind all the time the purpose. What is the outcome? The cash budget is working out whether you've got cash, so it's looking at money. The projected income statement is working with profit. It's working out what profit you got, so it's your income and expenses.